Hello, and welcome to the Credit Compass, your guide to navigating the complexities of European credit markets. Each week, we unpack the key developments shaping credit, explore the macroeconomic forces at play, and dive into the strategies that matter most for investors across Europe and the UK. This week, we're diving into yet another survey. Yes, another one. But this one from the World Economic Forum that deserves your attention. It polls chief economists from leading global institutions on their outlook for the remainder of 2025 and into the year ahead. We will also cover the latest in the fast-moving French government situation and the impact that it is having on markets. All right, let's dig in. The World Economic Forum survey paints a picture of a world economy defined not just by deceleration, but by divergence, a widening gap between advanced and developing economies and between regions that are navigating disruption versus those that are still struggling to respond to it. For Europe, the outlook is one of cautious optimism, but with an unmistakable fragility. Roughly 40% of economists surveyed expect weak growth to persist across the continent. However, the tone has notably shifted since the May edition of the report. 60% now see upside potential in Europe's growth trajectory, up from 47% previously. This is a meaningful shift, less because of booming fundamentals and more because of a recognition that the region may have underutilized growth capacity. In fact, a full one-third of respondents believe Europe harbors significant untapped growth potential, especially if structural reforms and investment tailwinds can take hold. Importantly, inflation expectations in Europe remain well anchored. Nearly 9 in 10 economists expect low to moderate inflation, which is helping to stabilize rate expectations. And as a result, 56% anticipate no further changes to monetary policy over the next 12 months, though a substantial 44% still expect further easing, a split that reflects uncertainty around the ECB's willingness to pivot from restrictive policy, especially given fragmented growth patterns within the bloc. On the fiscal side, Europe appears poised for a more active stance. 74% of respondents foresee fiscal loosening in the year ahead, consistent with efforts by several national governments to buffer weak demand, fund defense rearmament, and respond to ongoing industrial policy competition. This aligns with recent announcements in Germany and Italy to accelerate spending on infrastructure and green energy, which we have announced many times on this podcast, and are seen not only as counter-cyclical measures, but as part of a longer-term competitiveness strategy. Labor markets, however, are showing signs of strain. Across the survey, over half of respondents expect rising unemployment over the next 6 months, a notable shift from earlier in the year. Europe is a key contributor to this trend. The share of executives anticipating job losses in Europe rose sharply from under 40% to above 50%, raising the specter of employment becoming a drag on consumer confidence and domestic demand, just as the region attempts to stabilize. Another theme that emerged strongly in the European context is debt sustainability. While global focus has often centered on emerging markets in this capacity, the concern now increasingly resides within advanced economies, including the euro area. A striking 80% of economists surveyed expect debt vulnerabilities to grow in advanced markets, with Europe flagged as a particular area of concern due to rising social expenditures, demographic pressure, and low nominal growth. Interestingly, despite these near-term headwinds, many economists still point to technology and innovation, especially AI and digital productivity, as critical long-term levers for Europe. While the region may not match the pace of adoption seen in the US or China, there's a recognition that AI could play a key role in offsetting aging demographics and labor shortages. Several economists suggested that Europe's strength may lie in industrial applications and regulated deployment, especially in manufacturing, aviation, and logistics, areas where the continent retains deep expertise. Lastly, the broader theme of fragmentation, whether geopolitical, economic, or technological, features prominently. 56% of respondents expect deeper divergence between developing and advanced economies, while 78% anticipate a weaker U.S. dollar, which could offer some external support for the euro. But overall, the view is that Europe cannot rely on global tailwinds to carry it forward. It must engineer its own recovery through targeted investment, resilient fiscal frameworks, and greater policy cohesion across member states. In short, Europe is at an inflection point. The continent is no longer seen as purely stagnant, but it is not yet resurgent. The upside is real, but it will require coordination, reform, and a firm grip on political risks to be realized. For credit investors, this presents a nuanced picture, less downside risk than 6 months ago, but still far from a self-sustaining recovery. And on a related note, I had the opportunity to speak at an airline industry conference, ISTAT, this week. The discussion echoed the survey results. Supply chain disruption remains a top concern, growth is positive, and while AI may eventually help, the adoption curve will be slow in industries like this with long development cycles. Now, let's turn to France, where political uncertainty is spilling into financial markets. The country finds itself once again in the grip of political turbulence, with real implications for capital markets. Just weeks into his appointment, Prime Minister Sébastien Lecornu has submitted his resignation, throwing the government into disarray. This comes before his cabinet has had time to establish itself or outline a coherent policy agenda. In a last-ditch effort to restore some semblance of order, President Macron has asked Lecornu to remain in place temporarily to seek a solution within 48 hours, a window that may well have closed by the time you hear this. While the headlines emphasize political drama, what's concerning is the seeming indifference to the financial spillover already underway. French OAT spreads over German bunds have widened to their highest level since January, a sign of rising risk premium and market unease. This volatility hasn't been confined to France. Yields have risen in other highly indebted sovereigns, including the UK, as contagion effects ripple through. Equities have also taken a hit, with the CAC 40 declining amid this budgetary uncertainty. France appears increasingly unlikely to meet its budget deadline of next week, and in the absence of a resolution, they could be forced into emergency fiscal measures to prevent a government shutdown in January. In short, this is no longer just a political story, it's a market story, and one that warrants close attention in the weeks ahead. Sacré bleu, indeed. So, what are we watching for over the next few weeks, besides the French political drama? Despite everything we've covered, slowing growth, rising risks, political volatility, markets continue to melt upwards. Equity valuations are rich, credit spreads are tight, and it raises the question, are markets being irrational? Perhaps not entirely. Here's how we interpret it. Markets seem to be pricing in continued growth into 2026, led by AI-driven capital investment and potential productivity gains. Add in the rising price of gold, and there's a plausible narrative for an inflation risk resurfacing down the line. From a European perspective, the story diverges. Valuations actually remain within reasonable bounds, but credit spreads are tight. This reflects a lack of conviction in the European growth path, but we see the upside potential. Europe moves slowly, that's no secret. But German government spending is finally beginning to materialize, corporate and consumer fundamentals are reasonably stable, and interest rates are stimulative. Yes, France is a wild card, as is the UK, but the fundamentals across much of Europe remain solid. On a final note, we are heading into Q3 earnings season. As a result, pay close attention to quarterly announcements, in particular German industrials. Their forward guidance and order book trends will offer key signals for the fourth quarter outlook and beyond. We're watching to see if the long-awaited recovery is starting to take shape. That's it for this edition of the Credit Compass. If you found today's episode valuable, follow, rate, and share the podcast. And if there's a topic you'd like us to explore, please drop us a line. We'd love to hear from you. For deeper research and credit ratings, visit KBRA.com. Until next time, stay curious, stay informed, and stay resilient. Let the Credit Compass help guide your way.